Hey guys, how's it going? This is Mr. Arete here. So in today's video, I'll be going through a bull call spread strategy. So this is an intermediate level options trading method, and I'll talk you guys through some math and analysis behind an example trade. So let's get into the video. So the agenda for today, I'll be going through, firstly, what is a bull call spread and when do we use it? And then go on to talk about how does it work. And at the end, I'll have a bonus session for you guys where I'll go through with you two of the more advanced variables to consider before I enter a option spread strategy. So hope you guys enjoy. So in my previous video, I shared on the overview of the 4 option spread. So in today's video, we focus a lot on the bull call spread. So essentially what a bull call spread is an extension of a single buy call leg. So recap, in a single buy call, essentially what you do is you buy a call option when you expect the stock price to go up, which means that you have a bullish sentiment on the stock. Now for a bull call spread, it's exactly the same thing, just now you also add in a sell leg on top of the buy leg. So for example, you buy a $100 strike price call option. When you do a bull call spread, you're buying a $100 call option and selling maybe 110 or 115 call option at the same time. So in doing so, the bull call spread actually reduces the amount of premiums or risk that you have to pay. I'll go through more into details in the further examples. So this is something that you have to take note of. So let us now talk about how does the bull call spread work. Recap, when we buy a call option, right, essentially it means that we have the right to buy 100 shares of a stock at a certain strike price. And for that, we pay a premium. So the maximum loss for a buy call, a single buy call leg, it's essentially the premium that we paid. Meaning to say if the market eventually expires below our strike price, we only lose the premium, and that's the maximum amount that we will ever lose and nothing more. And if the stock goes up above our strike price, then we have unlimited amount of profits. For the sell call, what it means is we are obliged now to sell away shares at a certain strike price. And for taking on that risk, we actually receive a premium immediately as opposed to a buy call where we have to pay. So we gain the premium when the market price is below our strike price during contract expiry, right? Because it does not make sense for the person to exercise the call option on us, and therefore our sell call leg will just expire worthless. And for that, we'll gain the premium. Now, but if the stock goes above our strike price, let's say to $115, then we are obliged to still let go the shares at $110. Therefore, for sell call leg, we have sort of an unlimited loss depending on how high the stock market price goes. So how does a bull call spread work, right? So recap, I mentioned that the bull call spread is an extension of a single buy call leg. So let's say now we have a buy call leg based on the slides, and now we add a sell call leg to it, right? So now we have 2 strike prices, right? So let me give you an example just to illustrate. Assuming we bought a $100 strike price call contract, and for that we paid a $300 premium for it, and we sold at the same time a $110 strike price call option, and for that we received a $100 premium, right? Both contracts have the same expiry of 1 month. So what this means is the net premiums that we debited or paid, it's essentially minus 300 plus $100, which is minus $200. Alright guys, so now I'm going to run you through the different scenarios that can happen. For that, just please pay closer attention because there's some math involved. Alright, so recall that when we bought a call, right, the moment we buy a call, we have to pay a premium immediately. And for this case, you immediately have to pay or get debited $300. Now, when we sold a call, we immediately received a premium of $100 for this case. Therefore, our net premium paid or debit for this buy call spread is minus $200. Why is this important? Because no matter what zones that we are in later, this net premium paid has to be accounted for every single zone. Now let's go through zone A. So for zone A, let's assume that the stock price closes below our strike price of $100, right? So for this case, our buy call, we will lose $300, and our sell call, we will make $100. Therefore, our maximum loss for this entire trade is capped at $200, which is also the net premiums that we paid in the beginning, no matter how low the stock goes. Right, if the stock goes to $0, it's the same scenario, and that's the beauty of this strategy, right? Our net loss is capped at the total premiums that we paid. Now, in zone B, Let's assume that the stock market price closes in between our strike prices of $100 and $110, right? So what happens in this scenario is this. Our buy call will gain $600. Why? Because our buy call recall that we have the right to purchase the shares at $100. Now the stock market is at $106, which means we made $6 a share, and each option contract is 100 shares, therefore we make a net gain of $600 from the buy leg. Now for the sell leg, we will not lose anything because our strike price is at $110 and therefore it will just expire worthless. So our net gain would be $400 because we gain $600 from the buy call. And recall that I mentioned that you have to account for the net premiums that you paid, which is minus $200. So plus 600 minus $200 will give you a net profit of 400 US dollars for this scenario. Let us now move on to Zone C. So in Zone C, essentially, we assume that the stock market price closes above $110. Now let's use $115 as an example. All right, so for the buy call, we essentially will make $15 per share. Why? Because our strike price for the buy call is $100. So what this means is you have the right to purchase shares at $100 when it's trading at $115. Therefore, we make $15 per share, multiply by 100 shares per contract. Therefore, we make $1,500 USD. Now, for the sell call, right, we are obliged to let go the shares or sell away the shares at $110. Now the stock price is at $115, which means we will lose $5 per share. The same thing applies, we multiply it by 100 shares and we arrive at a loss of $500. So what this means is we will make an overall profit of plus 1,500 minus 500, which is $1,000, right? And recall that we still have to account for the net debit that we incurred at the very beginning, which is minus $200. Therefore, our max profits for this trade, if the stock price expires above $110, will be capped at $800, regardless of how much higher it goes. If the stock price goes up higher to, let's say, $150, right, this concept and this math will still hold true. So I hope from this example, you guys see the power of a bull call spread, right? Essentially, your risk is so low. The maximum loss that you will incur is only $200, and the maximum gain that you might potentially enjoy is $800, and that is actually very, very attractive. The other thing that I need to go through with you guys, right, is how you calculate your break-even stock market price, right? So essentially for this case, your break-even price is simply the buy call strike price plus the overall net premium that you paid per stock. So it'll be $100 plus $2, which adds up to $102. So what this means is after or at the expiry of both contracts, as long as the stock price is at $102, you will not gain or lose any money. And anything above, you will make. So in summary, for this bull call spread example, the maximum loss is simply your net premium paid, which is $200, even if the stock price goes to zero. Your max profit is simply the difference between your sell call and buy call strike prices, multiplied by 100 because each option contract represents 100 shares. You take that sum and you subtract away the net premium that you paid. So it'll be $1,000 minus $200, which is a nice profit of $800 maximum. Your break-even price will be simply your buy call strike price plus the overall net premiums that you paid per stock, and there will be $100 plus $2, which is $102. Awesome, now that we went through how it works, let us move on to the bonus section for today. So this is a slightly advanced concept, but I thought it would be very helpful to share with you guys just to show, the level of detail and analysis that I go through when I personally want to enter a spread. So before we go through, this is important to understand what is theta. So theta is actually a Greek in the options world. So what is theta? Theta is the rate of decline in the value of an option due to the passage of time, with everything else held constant, aka is also known as the time decay. So before we go through why is it important, just understand that when you buy options, right, time decay works against you and you're losing a certain premium every day. And when you sell options, time decay works for you and you're receiving some premiums every day. Okay, so let us move on to why is it important. It is important because when you buy options, data works against you, right? Because every day you're like paying a tax and you're losing money. And for selling, every day you're receiving a tax and earning some money from the premiums. Therefore, when we do a bull call spread, we essentially reduce the net theta for our trade. For example, when we buy a call, right, our theta is maybe minus $10 per day. And when we sell a call option, our theta is plus $6. Therefore, our net theta is minus $4 per day. Compared to if you were just to buy one call option without the sell, we'll be losing $10 per day. And therefore, theta is also a very important aspect to look at personally for myself when I choose whether or not to enter a trade because I don't want to be losing too much money per day, right, due to time decay. Therefore, we lower the net theta while still having the opportunity to capture the nice upside. So that is the benefit of a call spread. And for the second bonus for this video, I'll be sharing with you guys delta. So delta belongs also to slightly more advanced, but just listen through. Essentially, delta also belongs to one of the option Greeks. So what is delta? Delta essentially is how much your option price changes for every dollar change in the stock price. So if you have a delta of 0.3, what this means is, let's say your stock increases by $1, the price of your option will increase by $30 for bull call spread, and therefore you'll make 30 US dollars. So why is delta important when we want to analyze bull call spreads? The reason is because, right, to have a profitable spread, the overall delta for bull call should be positive, right? We don't want to be entering a call spread where the delta is so low or even zero. Then it does not make sense to enter the trade. So we need to pair this analysis with how we choose our strike prices and again linking back to our risk profile and risk management. So this is an overview of the advanced analysis that I think through before I enter a bull call spread. So thank you guys for listening through. We have come to the end of this video. I hope you guys have benefited. Thanks for watching. Again, I appreciate you guys and see you guys in the next video. Bye bye.